Global markets are on edge as geopolitics, central bank moves, and tariff uncertainties dominate headlines. To help us understand what it actually means for the equities in September, we have with us Mr. Harsha Upadhyaya, CIO Equity at Kotak Asset Management Company Limited. Welcome to the show, Mr. Harsha. So, first of all, I want to understand how are these geopolitical tensions, for example, US China trade relations, or the conflict in Eastern Europe or Middle East, how are these situations shaping the sentiment for an investor and equity flows?
If you look at geopolitical conflict, for example, Russia, Ukraine, it's been going on for quite some time. Similarly, the Middle East conflict also has been going on for quite some time. So, to that extent, I think the investors have kind of taken this in the expectations that the wars are going on. There will be some cost due to the war. Similarly, the trade relationship with the US vis-a-vis other countries as well as vis-a-vis India, the discussions have been going on for past several months. So market was well aware of what was happening around the trade negotiations. The market may not have known the exact level of tariffs vis-a-vis each of the countries. That may have come as a little bit of a surprise, but everybody knew that the global trade negotiations are going on and there is going to be a reset. So to that extent, I think these were known factors in the market. Having said that, the foreign flows may have got impacted a bit because of these issues. If you look at year-to-date foreign flows, they have been a negative $12 to $13 billion into India. So to that extent, one can say that probably along with a little bit of expensive valuations of Indian markets, these factors have also contributed to what FIIs have done vis-a-vis their investments into India. However, the domestic investors have kind of taken this in the stride and they have more than compensated for the outflows that have happened from foreign institutional investors. So on net, I think the mood is more or less neutral, I would say, at this point of time.
So I want to understand how is India positioned compared to global peers amid these slowing global growth but resilient domestic demands?
You're right. I mean, if you look at last decade, India has grown the fastest among almost all of the reasonably sized economies. Similarly, when you look at this year or the next 5 years, India is once again expected to grow at a much better growth rate as compared to many other economies, despite some of the challenges that we discussed earlier. And also, India happens to be one of the markets where return on equity for Nifty basket, for example, is about 15%, which is one of the highest. The kind of breadth and the depth that you get in India in terms of the choices for investments is also very, very significantly larger compared to many other economies. So overall, I think clearly India stands out in terms of the opportunities that are available for long-term investors. And also, when you look at the earnings growth rate, while it may have come off a bit this particular financial year, we do expect it to go back to low double digits as we go forward over the next few years. So net, there is a reasonable level of economic growth, a double-digit earnings growth, and the ROE profile of Indian corporates is also very, very strong. So to that extent, I think India is reasonably well positioned vis-a-vis global peers. And also one more point to remember is in terms of valuations, India has always been an expensive market when you compare valuations of India vis-a-vis emerging markets, right? The 5-year average overvaluation of Indian markets or premium over emerging markets has been about 70-odd%. However, because of the underperformance that we have seen in India over the last 12 months or so vis-a-vis emerging markets, for example, we have seen an underperformance of almost 23-24% over the last 1 year vis-a-vis emerging market index. And that has led to the premium valuations coming off quite a bit from above 70%, which is the average for last 5 years. It has come to about 40% or so. While India is still expensive, it's not as expensive as what it used to be in the past. So that's also a positive factor for somebody who is looking at India from a global perspective.
And what are your views on the corporate earnings for this quarter? Are the margins still going to be under pressure?
If you step back and see the quarter that has gone by, the Nifty earnings grew at about 8% on a year-on-year basis, which is somewhat one of the slower levels of earnings growth, one can say. The mid caps grew at slightly better earnings growth rate as compared to large caps. There was a decline in terms of small cap earnings growth for the third successive quarter. Having said that, the next few quarters, we are likely to see slightly better earnings growth rates. We do expect low double-digit earnings growth for the full year, that is financial year 26. So sequentially, we should start seeing slightly better numbers. We may not see that entirely in the second quarter of financial year 26. However, we do believe that margins are likely to hold up. There is no room for improvement in margins given that the volume growth has been quite weak. However, we should be able to see a reasonable level of earnings growth as we have seen in terms of first quarter earnings, continuing in the second quarter and thereafter probably improving a bit in the second half.
Which sectors seem relatively better placed for navigating these changes, and which areas warrant closer monitoring by the investors?
As far as the portfolio positioning is concerned, at this point of time, it's better to have a domestic orientation in terms of the businesses that you choose, given the fact that domestic businesses are far more resilient as compared to some of the global facing or export oriented businesses. Also, as we discussed earlier, the US trade negotiations and the reset that we have seen in global trade and commerce is somewhat of a challenge in the short term. So to that extent, the exporters may face a little bit of challenges. The earnings may be a little volatile. The sentiments towards those companies could get impacted. However, the domestic businesses which have very little global linkages are the ones which are likely to perform better. So in that context, we would be overweight on sectors such as cement, telecom, power, which are essentially domestic sectors where there are not too many global linkages. And we believe that the earnings stream in some of these segments of domestic market will continue to be a lot more resilient. And that's where probably you will see more investors looking for opportunities.
Thank you so much, Mr. Harsha, for joining us and sharing your valuable insights.
Thank you. Pleasure speaking to you.
So we hope this discussion helps the investors take better decision and understand the opportunities and risk shaping the market right now. Stay tuned to Kotak Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.